Hey everyone. So today we are discussing the iron condor strategy in S&P 500 futures. I've been discussing credit spreads before, but I thought maybe let's take it to the next level from two-legged options trade to a four-legged options trade. And I would like to get this done, in a meaningful amount of time. I don't want to take too much of your time here. And the idea is equip you with the basic understanding. Well, not basic, but you can at least once you go through this video, you should be able to put the positions on, manage it, and then take it off. And I will take you through the exact steps that I take to put these positions on. Even though it's not my favorite strategy because it's a neutral, market neutral strategy, I like to take some directional risk with being a quantitative trader. So on when the market goes up too much, I like to sell calls. But I've been really skeptical about selling calls in this very bullish market. So I've been using other markets like the commodities, the interest rates, and other futures options markets to take exposure. I'm staying away from the indices, but this is just for learning purposes. And I'm going to show you the exact process that I would have done if I was to take a market neutral iron condor strategy in S&P 500 futures. Now, the go-to expiration cycle, 46 days, perfect. I like to be around 45 to 50 days. And then let's take a look. So we first set up this put side. So iron condor is basically you're selling both sides of the market. So you're selling the put side and you're selling the call side. It's a defined risk strategy, so you do not put down too much money, but you have to be really patient with this one because it moves so slow. You have to be really patient with it. You might be in the trade for 25 days and you probably won't see any P&L. That's that kind of patient I'm talking about, right? So therefore, I stay away from this. I stay away from initiating an iron condor. I just think that different people work differently. For me, I do need to take some risk. I have to be a little bit aggressive in the market. So directional works best for me. And then when I manage it, I do convert it into an iron condor. But that's only when I manage it. But this is the one that we will set up right now. Like how to set up 17 deltas on each side. So we will right click here on the bid side at 5400 strike, right? First of all, let's just do a volatility check quick. Let's do a quick volatility check. The chart's pulling up. It's a little slow. Around 16. That's what the average has been all year. You get these spikes very seldom in this market. It's a very bullish market. Uh, Only four times in the past year, in the past 1 year, that you've seen anything like this, these spikes. So whenever you do see this, you have to sell this vol because look at this, it always comes down. Volatility is a mean reverting asset, so that's what we do. We sell it when it goes up. So 5400, right click vertical, and remember ES options are $20 wide. So from 5400, I'm going to go to 5380 on the put side. And oh, I did it wrong. I did a vertical, and that's what my go-to is. So I do a vertical on both sides. So that's what I did, but I don't want to do that right now. I'm going to do an iron condor. So here's a put side that we're setting up. So 5380. Take this down to one. Always start with one contract, and then ladder in if you have to. Don't trade more than two or three contracts. That's my opinion on this. Now let's go to the call side. 17 deltas is around 60-40. Now it's a very bullish market, so I'm going to give it a little bit of more room here and go towards 14 deltas. Even though I don't like to go that far, maybe 15. Let's start with 15 here. 60-50. Let's start with 60-50 strike, meaning 6,050 points. So you have to select on the short side. You're selecting 60-6050. On the long side here, you're selecting 6070. Okay, great. So this is how it will set up. Sorry about my throat here. Struggling a little bit. Okay, this is the one that I need to set up here. Okay, it looks pretty good. When you enter a trade, it looks pretty good. Now, the rationale here is this is the reason why I would not do this right now. Look at the market here. All the way up to the right, top right is when the hockey stick style move, and this is not even showing me the whole thing. This is the whole thing all the way to the right. So now you're selling a market neutral strategy here, meaning you're wrapping your head around these levels. So you're saying it will not go above 6,000, and then it will not go below whatever you strike that we saw there. This is we're wrapping it around here. I don't like to do that because I know that there is so much bullishness in the market here that it might go through it. Or there is a little bit of bearishness. I mean, I would sell calls here all day long because the market has been up so much. But being neutral at this level, you're kind of like, you are taking the risk that the market is basically going to stay sideways. And it can possibly stay sideways, not a problem with that. But because it has run up so far up so quick, I think the risk is on the downside. So you would have to sell that risk. So you have to sell these calls for the market to like correct itself a little bit. Now it can definitely go through 6,000. Fine. You can always sell the puts as well. Anyway, that's the rationale. A market neutral strategy. Let's go into the analyze tab. First things first, you would select your prices. Go to break even and then select the correct expiration cycle. You have to collect 1/3 of the strikes, 1/3 of the width of the strikes, in order to be above 70% or above 68%. That's the math. That's the probability of this trade. Have you collected 1/3 of the width of the strikes? Yes, you have, because your width is $20. The short and the long width is $20, and you're collecting $6. So as long as you do that, 1/3 the width of the strikes, you will be above 65, 66, 67. You'll be around that mark. And that's the one standard deviation move, meaning from here, the stock is expected to move up towards this mark, to this shaded area, and then down to this shaded area. So you are selling this as a neutral market strategy, and this is what your Greeks will look like. Your deltas are going to be completely flat because you've sold both sides at the same deltas. You collect positive $5.28 theta every day. You're short vol. I'm fine with shorting vol here because there's a little bit of a positive drift going on in the market. And then P&L open is if you pay this, that's what you would do. 625. And then what you do to like put the trade in, you right click, confirm and send. And this is where you will see all your buying power. So your buying power effect is $411 for this trade. Your total commissions to get in is 9, and to get out will be another 9. So that's $18. So you have to cover $18 in the strategy before you start making any money. So remember that. And then you are looking to collect 50% of the max profit. So max profit is $312. So you're looking to collect about $150. So you have to stay in this trade for over 100. As long as up until the trade is like it has given you at least $100 in your pocket, and then you just right click and send it. This is my paper trading account. Always practice in this. In these kind of accounts, do not go live until you've done at least 50 trades, all kinds of trades. So I will let the order sit here, and then let's talk about management a little bit. There's no management in these refined risk strategies in the iron condor strategy, because the only thing that you can do is, well, there is a way to manage. So let's say if the market moves either way. Let's say market goes up. So you would close the short put side and then you move the puts up. So currently you're selling the puts around 60, 50. Where are we selling the puts? 5,400. Usually we don't manage iron condor. We just let it sit there because we know our defined risk, total risk in there. But a lot of the times we do manage. So here's how we manage. We close, if it goes up, we close the put side, we move the puts up. And we sit there. If the market comes down on us, we move the calls down a little bit, all depending on how much time is left in this expiration. If there's not much time left, we move the spread out and then we go and look for other opportunities. That's how we do it. Any questions, let me know. Any feedback would be great. Thank you.